Welcome to Credit Monster, where high limits are achievable and bad credit is beatable. It's your boy again, Daquan, back in here with another video. Got a special treat. We're going to be talking about the credit score and how it works. This is the credit score fundamentals. Before I begin, don't forget to smash that like button and subscribe, and make sure you share with your friends, because this information is what we should have been taught in school. Now keep in mind, this is just the fundamentals. This isn't really advanced topics right here, but you may be surprised. You might learn something. A lot of people just don't know how the credit score system work, and I'm about to explain it right here. Let's go. Okay, y'all, so let's talk about the credit score fundamentals. So what is a credit score? The credit score model is between 300 and 850. So you can have a score between those two. The lowest is 300, the highest is 850. And this is used by lenders to determine the likelihood that you will pay them back. Okay. Now, there are many different models out there. The most popular is the FICO and the Vantage score. Now, a lot of people ask me, oh, well, how come my FICO is different from my Credit Karma score? It's because FICO is a whole different scoring model, and Credit Karma uses Vantage score. So it may look different than if you looked on my FICO or went on Experian and looked on their app. It may look different, but they're similar, and we're going to get into how they are similar. These models update on how they weigh certain things every so often, so that's another thing to take into consideration. But if you have between a 300 and 629, that is considered bad credit for the most part. If you have between 630 and 689, that's considered fair or average. If you have between the 690 and the 719, that's considered good credit. And if you have between the 720 and 850, which is the max, that is considered excellent credit. And that's where you want to be, and you will get there. So how do they determine your credit score? So this is the breakdown on how they actually determine what your credit score is going to be. So FICO, 35% of your credit score is basically your payment history. So that is how many on-time payments do you have in comparison to how many late payments you have. So once you have a late payment, you are not 100% no more, so you don't get that 30. Your 35% has been penetrated a little bit. So you want to make sure you maintain 100% payment history on time, so you could get the full allocation of the 35%. Then you have your utilization, which is how much revolving debt are you currently using, which is 30%. So it's relative to how much credit you have available and how much you're using. For an example, let's say you have a credit card that has a available balance of $1,000, and let's say you went to the store and got you a new computer and it was $500. Now you owe $500 to that credit card company, and you have $500 left in utilization. That makes your utilization 50% because you used half. So that will actually penetrate that 30%, the points that will normally go to your credit score, which will be 30% of the score. You will actually lower your score by doing that by up to 30%. So if you maxed out your credit cards, 30% will be taken off your credit score. That's about 150 points if we did the math. So that is very important to keep your utilization low, keep your credit card balances low. If you do run it up, make sure you pay it off at the end of the month in full, or a large chunk of it to where it's at 2%. 2% is the optimal the optimal level to keep your credit cards. Then you have your average age of credit. Now, a lot of people don't have the average age of credit. So they might have a good score because they got the payment history. They've been on time with their credit card payments and their other payments, and they don't use too much of their credit cards like that, or they pay it off when they do use it. So those two is in the pocket, but then it just be they only had credit for a year or two. So they're missing a good chunk of their credit score, which is 15%, which is the average age. And then I get many questions on how do I increase my credit when they have perfect payment history and they have perfect utilization. It's really nothing to do but to wait. You just have to let your credit age. Credit is like wine. It gets better as it age. You have to let it age. If you don't let it age, what they consider that is a thin file, meaning they don't have too much history on you. You're doing very great now, but we don't have too much history on you. You want to do this for the long term. This is a long term game, and the longer term, the longer you stick this out, the less of a risk you are to the banks, and that's how they determine whether they want to give you money or not, or credit or not. Another 10% of your credit score is based on the mix of credit. So basically that means, do you have revolving debt and do you have installment debt? They want to see both of those, that you could pay credit cards and that you could pay monthly payments that are scheduled for you. And we're going to get a little bit into that deeper in that concept in a future slide, but that's basically what a credit mix is. So if you have student loans, that means you have to pay every month, quote unquote, pay every month, right? That is an amortized loan. That's a student loan. And if you have a car note, that is another amortized loan. That means you have a scheduled payment that you make every month. Then if you have credit cards, which is revolving debt or revolving credit, that doesn't have a schedule that you have to pay on every month. But you are handling both types of debts very good. And that's what they want to see in that credit mix. Do you have both types of debts? And then the other 10% is inquiry. So are you trying to get credit, like a lot of credit? Inquiries is just when you apply for credit and they check your credit score. They do what is called a hard pull. It's two different pulls. There's a soft pull and there's a hard pull. A hard pull actually goes on your credit report saying, hey, this person applied for credit. And if you have too many of those, first of all, an inquiry drops your score between 2 to 5 points each one. And it lasts for a year. And then at the second year, it drops off your credit report completely, but it affects your credit score for a year. Now, if you have too many inquiries, it makes you look desperate for credit, and desperation is a risk for the bank. It makes it less likely for them to give you credit. Now, think about this like the law of attraction. I guess you could think about it like this. If you're thirsty, then 9 times out of 10, you're not going to get your thirst quenched because you're thirsty. It's kind of like if you was chasing that boy or that girl, you chasing that one person and they're trying to get away from you because you're chasing them until you act like you don't care no more. Then they like, oh, this person don't care about me. But that's a whole nother thing. But that's kind of the concept with inquiries. You don't want to look thirsty for credit. You want to look like you're financially stable. When you have a whole bunch of inquiries on your credit report, it looks like you're going through something, and that's a huge risk for the bank, and they don't want to extend credit at that point. So Vantage score is a little bit more convoluted, means confusing. It's a little bit more confusing than the FICO. Is a little bit more simple. More people use FICO. More credit institutions use FICO. Back in the day, it used to be more Vantage score, like back in the 80s. Generally speaking, more credit card companies use Vantage score, and more mortgage companies and car dealerships use FICO. But now if you look at Google, it says that FICO is used more. But honestly, both of them are used. So you just want to be good across the board with everything. Most free credit apps use Vantage. I believe Vantage is just cheaper to get as far as the score, so it's cheaper for apps to get that. So that's why when you try to get a FICO score, you got to pay for it. You got to pay a lot of money, generally speaking, to get a FICO score on a monthly basis. So there's two main types of credit, and this is very important, so please pay attention. It's two main types of credit. Is revolving credit, which is like credit cards or lines of credit. And then there's installment credit, which is a scheduled payment, student loans, car notes, mortgages, etc. These are installment payments. So the main difference between the two is that installment credit has an amortized payment schedule. That just means you have a schedule on when you pay this debt every month or whenever. It could be every other week or something, but normally it's every month. And then revolving credit does not have a scheduled payment. So normally, like if you use your credit card, you might not have a monthly payment in a particular month. Or if you didn't use it, or if you used it like at a particular time of the month, you might not have to pay it to the next month. Not this month, but next month. So credit cards don't have a schedule. Like it doesn't have a schedule when you're going to have to, pay it all the way off. Versus an installment credit does, or an installment loan. That's another word for credit. Loan and credit is synonymous. So revolving credit is what affects your utilization on your credit score. Installment credit generally does not. FICO doesn't generally keep that. They don't take account of your car note. They just only see if you want to. They just care about if you paying it on time. That's all FICO cares about. They don't care about the balance of that. The only thing FICO really care about the balance of is your credit cards, because that tells the banks if you're thirsty for credit or not. Because if you ran up your credit cards and you trying to get another credit card, it's like, why when you ran up these credit cards? You see what I'm saying? So how else do lenders determine your credibility? So lenders don't just look at your credit score. They also look at your income. Now, income is very important. They look at your income, and so this is a scenario. This is like a meme at this point. People asking, would you rather have an 850 credit score and no money, or would you have $100,000 and a 450 credit score, like a low credit score? And a lot of people say I'd rather have that 850 credit score. But see, what the question does not present is, do you have an income? Do you have cash flow? Because that's very important. If you have 850 credit score and you tell the bank that you have no money, no income, but you have an 850 credit score, you're not getting any credit. You're not getting any money. It's not going to lend you no money because you have no income to pay them back. And that's what they care about. That's all they care about. Do you have income to pay them back? They have things called Plaid, where you could log into your bank account and they make sure you have income, versus the stated income, which was back in the day. This is like, a trust system. You have to state your income, state your household income, and they have to kind of believe in you. But now we moving on to where we got fintech banks that allows these banks to go into your bank account to make sure you have income. So just having a credit score is not good enough. You have to have an income. When you go get a mortgage, they verify your income. You need to show pay stubs. You need to show tax returns, because they need to verify the fact that you could pay them back. They're not going to give you credit just off your credit score alone. So this is something that's very important. Do not put too much emphasis on your credit score. Also make sure that you're making money, because if you're making money and you're financially stable, your credit score is going to increase, regardless, as long as you have your head on right and you want to pay your bills on time. As long as you have money coming in, you're going to be able to do those things and your credit score is going to be good. Not the other way around. So just keep that in mind. Banks need to know if you're going to pay them on time. If they can't determine your income, then you're too great of a risk for them, because they don't know if they're going to get their money back. And banks do not like taking risks. This is why if you have bad credit, they're going to charge you more interest, because they're taking on more risks because you have bad credit. If you have good credit, they're gonna give you a little bit less interest. They're gonna charge you less interest because you're more likely to pay them back. You're less of a risk. The more risk, the more interest you're going to have to pay. Okay, so really keep that in mind. Really understand this. This is important for you to really understand, and do not let nobody tell you otherwise. So I know this is what y'all want to know. How do you get perfect credit? Credit is a reflection of how you handle cash, aka money. Okay, money, and the reason why I separated those terms, this is kind of more esoteric, is because money can mean credit and it can mean cash. Money is a blanket statement. I'm talking about cash in the bank, cash, liquid cash that you could take out today and slap on the desk. Cash. Credit is a reflection on how you handle that cash, because if you have no cash, then you wouldn't be able to pay off your obligations, which is your credit, and you would have bad credit as a result. So you want to make sure you have cash coming in. You want to make sure you're handling cash properly, and as a result, you should be handling your credit properly. So how do you get perfect credit? You budget. You want to budget your expenses because you don't want to live above your means. If you live above your means, you're asking to have bad credit, because it's going to come a point in time where the money isn't coming in. You might get sick. You might get hurt. Somebody told me today, tomorrow isn't promised, so I can't wait 2-3 years to build credit. But see, credit is a long-term game. It's not a get. If you want to get money fast and get the money, get the cash fast. Go ahead and get your cash fast, but don't count on no credit, because credit is a long-term thing, especially when you don't have that much cash coming in. It's going to take you even longer to build credit. So you want to budget your expenses and live below your means so you could pay off your obligations, so you could be able to get credit and make sure you could pay it off on time, and in turn you will have good credit. You want to pay all your bills on time. You want to keep your revolving debt low and paid up each month. Okay? So them credit cards, do not run them up and then pay the minimum payment. Like, don't do that. That's how you get bad credit, because eventually, like I said, anything can happen. You could get sick, you could get disabled, then you have no cash coming in. Then you can't pay those monthly payments, then your credit score will get wiped to destruction faster than if you didn't have no minimum payments. You know? So you want to keep those balances low on your credit card. Like I said, 2% or lower. And do this for 2 to 9 years. Yes, it's a long-term game. It's a marathon. This is finances. It's a marathon, not a sprint. Get as much cash as you possibly can, and amplify your income with credit responsibly. That's what credit is all about, is to amplify your income. It's called leverage. When you could get $100,000 loan to get a rental property because you know the monthly payments is only $1,000, but you could make $2,000 off the rent. That's a $1,000 profit after you pay off the debt each month. That's amplifying your income, because at the end of the day, you might not have that $100,000 right now, but you have a game plan to pay that $100,000 off with the money that you take out in credit. But a bank won't trust you with that unless you have credibility, unless you already prove to them that you can handle that by already making that money, by already handling accounts at that magnitude for some time. It's a marathon, y'all. It's not a get rich quick. Stop believing in these fairy tales. And I know y'all not gonna like me for this, but I'm gonna tell y'all the truth. I have integrity, and I'm going to tell y'all the truth. And people who want to know the truth, y'all can stay on board. People who want to, get rich quick and get, get an AU, an authorized user, and think you're going to be good, and then try to get a mortgage, and then now you're going to jail for mortgage fraud. You know, people who want to do that, y'all could unsubscribe, y'all could get off my channel. This is for the people who's really trying to build sustainable wealth over time, because time is very relative to money. They have a very special relationship. Now I'm going into a little deep, and we're going to get into the money stuff very deeply on this channel. Trust and believe. I just wanted to lay down the fundamentals of credit for you guys so y'all could understand the landscape of credit. I really hope this was valuable information. So don't forget to like, comment, share, and subscribe, because this is the type of information we should have learned in school before graduating the 12th grade, so we would have been good in life. We had to make mistakes to learn this game. Once I get 1,000 subscribers, we're going to do a special live stream for everyone, and you can ask me anything you want. So get them subscribes up. I catch y'all on the next one. Peace.